Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So for those that follow us, we've been talking about central banks we started talking about it a little over a month ago in terms of the banking sector. But for those that have been following us for an extended period of time, we've been talking about how rate rises were necessary to shake out the problems that are in the market, where people have said to me, it's like, Mark, how do we fix this? It's like, raise rates. If you raise rates, you're going to shake out a lot of the I don't want to call it junk, but some of the problems out there, because you've had a lot of lackadaisical due diligence. You've seen risk management go sideways. People haven't been hedging properly. And unfortunately, some of the people in some decision-making seats have never seen a rate rising cycle, and they don't know how to react. And we've seen this multiple times now with these small banks. And we want to go through some of these different pieces and what is happening. How is this going to play out? Is there contagion? Is it contained? Short answer is it's not contained. There will be contagion. It doesn't mean that the financial system's going to collapse. It doesn't mean that there's going to be a lot. Doesn't mean that this is the end of the US dollar. It just means that there are balance sheets that are going to be under pressure. We keep hearing more and more of them, 25, 30. People have talked about Credit Suisse, and I'm going to be very clear. Credit Suisse has had multiple bailouts since 2008. That is not surprising. It had to happen. It's going to put pressure on UBS, but realistically, that is not going to be the contagion piece, and we're going to show you why we think that's going to happen going forward. So one of the things that we wanted to look at is just what happens in the market, especially globally speaking. So your real money flows to emerging markets have started to come down. When you look at flows into China, they've also started to slow. You're going to see a lot of risk off, and that's where a lot of people are going to move to cash. That cash based on deposits will likely go into treasuries or something that is going to have a shorter duration. And that's why we've seen the spread snap back. And we're going to show you some charts, because remember, we've shown the 2-year versus the 10-year was at this massive spread to the negative, to the downside. When you look at the inversion, something akin to 1981. And what we've been saying is that's going to snap back. But in order to get that snapback, you need fear. You need something to drive you into some of that short duration. And that's when we had some of that movement, some of those adjustments where people then turned around and started to adjust some of these inversions in general. So again, that's when we look at what has happened. And just to touch on, the Silicon Valley Bank. So the problem with Silicon Valley Bank is only about 20% of their deposits were covered by the FDIC. But when a venture capital firm invested in a company, they had you go to Silicon Valley Bank, and then that bank would then write you a loan. And your deposits would go there, and then they would write you a loan for equipment, for some sort of facility, something else, something that needed to happen. But you couldn't get a new loan until you paid that one off. And that created problems, because now you have multiple loans to startups that may not be cash positive, may be struggling to get through. But at the same time, so they're drawing down their deposits. You have this money that's been lent out. But then their hedging strategy was duration risk. So they were buying long-term debt, 10-year, 20-year, 30-year paper to hedge out some of their shorter-term loans. Now, the problem was when the rates started to do what it was doing in rate rising cycles, they owned debt at, 80 basis points to 1%, that all of a sudden started to get much cheaper. And they didn't adjust to show and to match up. So now all of a sudden you get this cash crunch. You go to liquidate this portfolio, and you're finding that obviously, especially in a stressful period, it has value that is much well below what it should have in a normal market. And that's the problem with fire sales. As somebody who was on the overnight desk at Morgan Stanley Investment Management during the 06, 07, 08 situation, I can tell you how quickly liquidity can dry up, how quickly the market can turn against you. And those are things that we have to look at when you start looking at these stress cycles. So, which is why you're going to start to see a lot of this money start coming out, and that's where you're going to get some of the skittish moves. And it's important to look at what the Fed is trying to do, and how there are people in the market who say, we need the Fed put. It's like, we don't. And I think it was summed up very well in this statement. The put kills the market's ability to reprice assets to their true value, and in some cases wipe out bad assets or bad actors. And I think when you look at bad assets and bad actors, the thing that's beautiful about America is that we have a very robust bankruptcy system. And that bankruptcy system allows you to try and fail and then try again. And if there's something of value in what you created, it'll get picked up. You'll get a bridge loan. You'll be able to pick something. You'll be able to restructure. If it's something that doesn't make sense, it'll go to auction. Something will happen, and as much money as can be recovered and put back to work. But when you have these zombie companies just absorbing all of this capital with not actually churning any type of growth, and then you had this ZIRP or zero interest rate policy and quantitative easing creating lackadaisical due diligence, poor risk management, poor hedging strategies. So then all of a sudden people got lazy and they said, oh, well, it's this guy went in, therefore this is okay. We're already in it and we're okay with it. We're going to go in again. It's like, well, how about you readdress or reevaluate what is happening in the market right now? So then when we look at consumer confidence, global consumer confidence, when you look at the diffusion, it's gotten better. And this is one of the things where when we come into situations like this that are very fluid, sometimes data doesn't matter as much, because things are going to change very quickly. And especially when you start looking at final sales to private domestic purchasers in real terms have come down, which is why we continue to see pressure in earnings potential. The reason why we continue to see pressure on profit, and just essentially we're going to have an earnings recession just as much as we're going to have pressure elsewhere. And this is what we were talking about when we look at crude demand, when we look at other types of, economic bellwethers that the economy has been ringing warning bells all around the world, and people are like, oh no, it's fine. The Fed put is there. The central banks will bail us out. But the law of diminishing returns, which just means that there's only so much that can be done, which is going to limit the amount of opportunity for some of these pieces. And again, it comes down to that moral hazard. When you look at the swap lines have been opened in the international market, and this is enables them to essentially issue U.S. dollars into foreign markets if there's a foreign liquidity shortage. But it's important to appreciate that there's a lot of liquidity out there, and we've seen a lot of liquidity in the market in general. Then when you look at equities, people have increased cash, but there's no fear in the equity world. And I'm not saying that the world is going to end, that the S&P 500 is going to go to 1,500, but there's a certain amount of caution that should start to come in, especially when you start looking at credit default swaps. So U.S. sovereign credit default swaps, this is a bet or insurance if the U.S. government is going to default. And you can see that it has gone higher. It's pulled back a bit, but the fear on the debt side is real. And that's something that needs to be looked at when you're starting to account for some of these different pieces. Now, this was Michael Burry put this out and then quickly deleted it, but luckily it was grabbed. And here you can see the unrealized losses versus deposits above. And then so you have the unrealized losses and then the deposits. So some people have asked me, Mark, which ones do you like? And we've said M&T Bank and PNC Bank are the ones that we think have always been in a really good position, and that they're going to be able to go out and purchase some of these banks. And then Fifth Third is another, which you can see is on the bottom of that line. But obviously in that lower quartile, they're in a really good position, and they're going to be able to go out there and purchase assets that make sense, deposits that make sense. And that's where you want to be, is where you have some of that strength. Because again, there's always going to be more opportunities to short, more opportunities to take these to the downside. But there will be winners. And given as my old boss used to say, in a recession, every, correlations run to one. But when people start to pick up the pieces, that's where you have this opportunity. And this was, again, history doesn't repeat itself, but it rhymes. Any type of cliche you want to look at. I thought this was a really important chart when you look at some of the side-by-sides between 73, 2008, today. I am not saying they're the same. I'm not saying that I'm saying there's similarities in terms of what happened in 81, what happened in 86 into 88 with the savings and loan crisis, what happened in 08. There is a lot of similarities across these. They're hitting different levels. The late 80s was a savings and loans crisis. 08 were the big banks. Now we have the small regional banks, small, medium regional banks. And there's something to look at, but each one had a catalyst. And the problem at this point is we have very low unemployment. We have elevated inflation. And now there's talk of, well, let's just go out and secure and backstop all these deposits. Well, it's like there's $18 trillion in deposits. And the Deposit Insurance Fund, the FDIC, has $125 billion in it. At what point do we have to step back and say, look, FDIC is for a backstop, but how do you back it? And do you say, oh, well, the Fed's going to back it? So then the Fed would have to then print $18 trillion to back it if things were to escalate quickly. And not to say that all of this would go away at once. It wouldn't, but you're looking at a cycle that would become a bigger problem. And the whole factor of a bank is to take deposits, which on their sheets is a liability because they have to give that money back, but they have overhead. They have money to make. So they take your deposits, they then turn around and make loans with it, whether it be credit cards, whether it be on businesses, on real estate, on residential and commercial, C&I loans. These are that, and that's how they make their money. But they have to do the due diligence. Does the facility exist? Is it going to make money? Can it carry this level of leverage? And those are key pieces. And then obviously you have other overnight capacity, other types of ways to make money. But this is the key. That's their job. That's their function. And if you have banks that are not doing that function, well, you need to go into a bank that can, and you have to start looking at this and doing more due diligence on who your banker is. Who is your bank? Who is backing you? And I think a lot of times, and obviously as someone who has also done startups, there's a lot to think about, but this is an important piece when we look at getting back to normal. Now, the MOVE index, as you can see, going back to 1987, the only time bond volatility was higher was during the great financial crisis, and we're just at the beginning of this one. And that's why when you look at the unknowns and the backstops and things they're looking to do, you have to put into context that there is a lot of volatility out there, and to be levered short or long is a concern. You can try to pick your spots on the buy side because there's some things that are going to be very cheap, but you have to look at, well, should I be short anything? Is there anything that I should protect myself against? Because this is a point to move towards the neutral, or just take down risk in general and make sure that you're not on the wrong side of some of these moves. While the Fed put, when you look at the balance sheet, they increased liquidity by $297 billion over the last week, the largest spike higher since March of 2020, and they essentially nearly half of quantitative tightening since April was undone in a single week. But again, the law of diminishing returns means that for every new dollar, it doesn't go as far. And if you think about the sheer volume that got pushed into the market in 2020 between both monetary and fiscal policy, the money's not going to go as far. So that just means that you're going to need an exponential amount more than you did in 2020 to have the same impact, or to buy one growth point. But there is a point in the law of diminishing returns that every new dollar actually has a negative incremental impact, or a negative util, as they say in theory, economic theory. And it just, but when you look at inflation has a lot of drivers, and monetary policy is a core one. And again, we have so much liquidity, and we've had nothing but liquidity increases since 1941. There have been points where there's been zero increase in M2, but M2 has only grown since 1941 until last year, where we had a decline of 2%. After constant inflation, constant increases in M2, we had 2% decline, and this is what happens. And that's when we really have to take a step back and look at how levered is the system. And this is why zero interest rate policies, when you look at Greenspan, he first introduced the idea in 1987 in terms of not so much ZIRP or zero interest rate policy, but low interest rates, and how that could help backstop and no longer have these deep recessions, which have continuously been proven flawed. Now, when we look at the weekly net lending by small and large banks, you get an idea of how important small banks are to the system. And one of the things that we've been talking about for a very long time is our concern in the real estate market. And commercial real estate, as we have seen, has come under more and more pressure. And that's where the small banks have some of the largest pressure points, which is why we've been saying that as bad debt expense increases, some of the valuations of these assets come down, there's going to be a lot of pressure on smaller banks. And that's when we started to see these cracks. And just to put it into context on small bank versus large bank, you get an idea that commercial and industrial loans, banks with less than $250 billion in assets, is 49% of that. Consumer loans, again, 45% of it. Commercial real estate, small banks, or less than $250 billion in assets, is 80% of that market. Residential real estate loans, small banks, is 57% of it. That is a huge exposure to a market that is coming under significant pressure. As we said, we had Brookfield that defaulted on $1.9 billion in loans. You had Blackstone defaulting on 513 million euro of loans. Again, commercial loans. That is where we see these pressure points. Now, the fear factor is in markets is still there, but it's much less than earlier this week. Markets now price a Fed on hold through September. So that's why the Fed funds that's going to announce tomorrow, today's Wednesday, depending on when this comes out, and tomorrow we're going to have a Fed funds rate decision. We saw the ECB go up 50 basis points, the BOE saying they're only going to go up 25. And the view was that the Fed was going to increase 50 basis points this week. Now, the likelihood is that we're actually going to start getting cuts by the end of the year. But the problem is inflation hasn't gone anywhere. And this is why we have said constantly on this show, repeatedly, that there is a big issue when you look at inflation, when you look at what the Fed is doing. They're waiting too long. There's no reason why at the end of 21 and all of 22, we had low rates. We buying MBSs, we needed to see this happen sooner, so we would already be higher and have that capacity to to cut rates. But again, we're not in front of inflation. We are by no means anywhere that we could tolerate some of this stress. While the thing about small U.S. banks is that they're not small in aggregate. As they dwarf large banks in commercial real estate lending, the difficult trade-off facing the U.S. is between protecting uninsured depositors at small banks versus a potential deep credit crunch. And that's the biggest issue. And that's when you start looking at inflation, what they need to see is asset prices coming down. But as asset prices re-rate, that's going to bring down real estate. Real estate saw this massive bubble form as they bought mortgage-backed securities, as they continued to push and drive this inflationary narrative. But small banks were lending at ridiculously low rates. And then they were hedging on duration. And then as the curve shifted, that is where they've gotten caught. The U.S. is trying to avoid that credit crunch, which we usually only see in emerging markets, with regional U.S. banks have been especially important lenders in residential. When you look at that top right, now this is just looking at year-over-year growth, and you look at how the regional banks have really been the driver across real estate and consumer loans. Now, as we know, the consumer is coming under pressure. Wages have not kept up with inflation. Credit card debt is rising, and that's squeezing the consumer, and that's why you're seeing those bad debt expenses increase. And I think it's important to look at where all of these, and in our insights that are going to come out this week, we go back to the 60s in this. And there's been just a steady increase in loans and leases. There's been a steady increase in C&I loans, where all we have is this constant increase. And that's why there's so much leverage that has been baked into the system. So every incremental increase in rates has a massive impact, which is why we've been talking about that rates have been too low for too long, because you're having essentially debt written at the wrong number. Then when you look at some of the leading indicators, 11 straight months of month-over-month declines in the leading economic index. Streak has never been seen without the economy already being in or heading into a recession. And this was before Signature, Silicon, was it Silver Lake Bank. So again, there's even more pressure now than there was. And let's look at it in general, the willingness to lend. So now, even if rates come down, so say the Fed comes out, pauses, well, who's lending? Now you're looking at your bad debt expense going up. You're looking at your liquidity problem. Is there a reason to go out and lend? And so, again, there's no willingness to do this. And as you look at it, we were already in recessionary territory. Where are we going to be now? And again, that's why we see a lot of these slowdowns. And to give you an idea on where, it's real estate. The question is, how long are they going to pull back before they start investing in real estate again? The U.S., and then when you look at what matters for growth, which is this black line, which is that real GDP growth, is the credit impulse, that blue line, the second derivative of credit. Again, that impulse, that reinvestment, as you start to see that dollar move through the system. So assume we can stabilize credit and avoid an outright credit crunch, the second derivative still turns sharply negative, which is why we still see that drawdown in real GDP, which is why we've been saying this recession is unavoidable. It's telegraphed. Everyone knows it's coming. You can see it. You can almost feel it. It's palatable. But here's where more data is showing. The U.S. is now a classic impulse story. Usually it's hard to disentangle demand from supply and credit impulse, but the change in the flow of credit. But again, Silicon Valley Bank and ensuing pressure on U.S. regional banks is a true exogenous shock that will drive that impulse down, which is why when you look at credit impulse and then domestic demand, we are already seeing those pressure points. Now, when we look at the Fed opened up their discount window, U.S. banks borrowed over $150 billion. It was actually $152.85 billion via the discount window. And now, as you can see, it blew past the record, which was in 2008 of 112. Now, the Fed's new emergency facility or bank term funding program is being built up. There's a view that it could come to about $2 trillion in backstops, and then that would be used to fund it. But when you look at it, it's like, all right, well, they're creating a new facility of $2 trillion. But when you look at RRP, or the reverse repo purchase program, there's over $2 trillion in that. So it's like, how much more liquidity are we going to put into this market? And that's when you start looking at inflation. Inflation continues to drive above levels. It continues to drive up. And when you look at trim mean, when you look at sticky, core, all of these things are going higher. And now their ability to lend their borrow is going to come down. So are we really going to see inflation start to come down? On the demand side, yes, you'll start to see a little bit of fear, more panic, people doing less. But monetary policy is also a key driver in inflation. And as we get this renewed QE, it's like, all right, well, now what? Yeah, like are asset prices going to go back up? Are you trying to reinflate a bubble that's now popped? And that's where we continue to see this kind of flailing around a bit. U.S. non-residential investment and future capex, as you can assume, has come down. And this was even before we really had the banking issues. So that's why capex we expect to come lower. All the while, when you look at outbound tender volumes, trucking continues to show signs of weakness. Volumes have slowed since the start of the month with no signs of firming. The goods economy looks to be teetering after a promising start. And that's what we've been saying, is that it's not that we're going to get this collapse. It's just we're not going to get these nice increases. We're not going to see these steady increases. Instead, we're going to see steady declines, which is going to reverberate through the system. And we actually had a reversal down in University of Michigan consumer sentiment. And this was before we actually had the issues in the banking sector. So you can just assume what that consumer sentiment is going to look like. All the while, February industrial production went sideways. But again, this was before anything happened in the banking sector. New orders component of the Philly Fed index sank further into contraction in March, now at level firmly consistent with prior recessions. And this data is compiled prior to what we saw in the banking sector. So again, you get an idea of how these data points were already worsening, and now we have another level to the downside. And then just like the Bloomberg financial conditions, just putting it into context, you saw that deep drop to the tightest since March 2020. And it gives you an idea of how the Fed could point to this and say, we can pause now. But then when you look at inflation, when you look at unemployment, or maybe they pause to let this play out and then they start to continue raising rates. But it's going to be difficult to see them again essentially step in and try to slow. And then the 7-day change in the spread between the 10-year and 2-year has had this big increase. March 8th, the spread between the 10-year and 2-year Treasury yields hit negative 1.07, the most inverted yield curve since September of 1981. 7 trading days later, the spread narrowed to negative 0.42, a 65 basis point increase, this was the biggest 7-day steepening we've seen since the 2001 recession. But you get an idea of how inverted we are and how much further we have to go to give you an idea of the pressure points. So during the last 6 U.S. recessions, we saw the yield curve 10s minus 2 steepen aggressively as the Fed entered a rate cutting cycle. But it's going to be difficult to see how they can get into that given the pressure that remains in other areas of the economy, even as we have this banking problem. But again, this is also going to flesh out some of those issues. Now, looking at some of the leading indicators, Philly Fed index rose to a negative 23.2 versus the prior of 24.3. But again, if you think about against the estimate was negative 15. So negative 23.2 gives you an idea of the pressure. March New York business activity rose to a negative 10.1 versus the prior of negative 12.8. But remember, all of these were prior to the issues that we've seen with the banking sector, which is why we continue to see some of this pressure to the downside and why we think things are going to get a bit worse. Empire State manufacturing new orders came down. Philly Fed manufacturing new orders also went down. Now you can see breaking to new lows. And these are the leading indicators. And all of this was happening prior to what has happened with the banking sector, to give you an idea of where the economy was prior to what has happened and why we think this is going to continue to get worse. And there's going to be more pressure across the board. Average work week within the Philly Fed index continued to fall in March. And then when you look at Capex plans, they've dropped to the worst since the great financial crisis. So again, spending is coming down, pressure is growing, and that's where we continue to see a lot of these issues, which are not going away, which are going to get a bit worse when you look at some of these leading indicators in the U.S. Homebuyer competition, not what it used to be. Homebuyer, and again, if you're looking at this as a homebuyer, you're like, my God, I'm not buying a house right now. Even though rates have come down, mortgage rates have gone up. Because if you're a bank, you're like, I am not lending at that rate anymore. I need a higher rate because my risk just went up. So you're going to have to pay a higher rate to risk adjust for myself. And that's why when you look at 30-year mortgages that were written at 2.5%, 3.5%, now that's why the golden handcuffs are there. If that family or person tries to sell that home, there's not enough equity because they were bought at such ballooned, just crazy high prices, low rates, that you're going to have to see that, which is why we've been calling it the golden handcuffs, because it's hard to sell knowing that you're stuck in that. Number of multifamily units under construction continues to soar, creeping higher towards the peak in early 1970s. And then when you look at 5 units or more, we're actually above where we were in the 1970s. So now not only do you have pressure on that end, but now you have the layer of new equipment coming on. You have new volume coming in, which is going to pull down those asset values even more. But what about the company that borrowed to do this? They borrowed to do this, and they borrowed from a small bank. And that, again, you can see how this continues to propagate more and more problems, which we don't think are going away anytime soon. So that's what we have for you on this topic. We're going to continue to follow it. We think that there's more pressure out there. There's going to be more contagion. There's going to be more issues because, as we've been saying, the liquidity covered the cracks. It paved over the cracks, and then when you start raising rates, those cracks get revealed. And even though they were papered over, they got bigger and bigger, and they continued to expand. And now all this new liquidity essentially disappears down these cracks. And now you have to address the real issue. And as we've been saying, defaults bank failures are a symptom of poor management. And we really have to address poor management, and is backstopping management the right way to do it? Because again, we've continued to see a terrible management style on risk, on due diligence, on hedging, and it's time to call them out on it and reward the people that are good at risk management, that are good at deploying capital, that do their homework and don't put all their eggs in one basket. And I think that is a huge thing to watch going forward. So hopefully this was helpful. We'll be back with the FSC show this week, and then back to our normal schedules of EIA, Econ, FSC next week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.